So I've worked on Wall Street for a few years, and one of the most surprising things I've learned is what banks don't want you to know about money. So in this video, I'm sharing 2 things banks are hiding from you and how you can take advantage of this information to make more money. First, Henry Ford once said, "It is well enough that people of the nation do not understand our banking and monetary system. For if they did, I believe there would be a revolution before tomorrow morning." You might believe that if you go to a bank teller and deposit your cash, that you'd be able to withdraw your money whenever you want. But that's not true. Banks can and do limit how much of your own money you can take out, or even flat out turn you down. The reason for this is because banks don't actually keep all your money on hand. The truth is, when you store your money in a bank, the bank will immediately borrow that money and lend it out. There's potential home buyers looking for mortgages, businessmen trying to get their ideas off the ground, and even the government looking for more money. Banks will generally charge these borrowers anywhere from 6 to 40% interest for these loans. Basically, banks use your deposits as capital to finance other investments so they can make more money. But don't worry, because you get a cut of that profit too. If you use big national banks like Chase, Wells Fargo, or Bank of America, they'll turn around and thank you for your involuntary generosity by slapping you in the face, by paying you an interest rate of 0.01%. So if you keep $10,000 in a Chase savings account, they'll pay you $1 in interest at the end of the year. Meanwhile, they're potentially earning $4,000 by lending your money out. Similar to scalpers, they'll buy a ticket to a Taylor Swift concert at normal prices and then sell it at an outrageous markup and pocket the difference. In the 1950s, those in the know, those in the banking industry, had a name for this whole operation. They called it the 363 rule. Basically, customers, like you, would deposit their money and banks would take it and pay the customers a 3% interest rate. Then they would lend that money to borrowers at a 6% interest. After that, the bankers would go to the golf course by 3 p.m. But nowadays, it's more like the 0.0143 rule. Next, this is all legal thanks to fractional reserve banking. Basically, the Federal Reserve doesn't legally require banks to keep all of their customers' deposits in their bank. For instance, in 2019, banks only had to keep about 10% of their customers' deposits, and then they can do whatever they wanted with the other 90%. So if you deposited $10,000, the bank would only need to hold on to $1,000, and then they could lend out the remaining $9,000. Now, there are pros and cons to the fractional reserve system. The most common pro argument is this is how we keep powering the American economy. And the most common con argument is what happens if people want to withdraw more money than the bank is holding on to, which is the whole reason banks have withdrawal limits, because they literally might not have enough money to give back to you. But in 2020, during the pandemic, many people started withdrawing and hoarding their cash. Naturally, the Fed wanted to avoid banks running out of money and further fueling the panic, so the Fed decided to go from a 10% fractional reserve system to a 0 reserve system. This meant that banks were no longer required to hold onto any of your deposits. They could, in theory, lend out 100% of it if they wanted to. Today, the only thing keeping banks from lending out every single dollar of your money comes back to interest rates. Nowadays, the Fed pays the banks an interest rate as an incentive to keep the cash in the reserves. And I have it on good authority that it's a lot more than that 0.01% that the big banks pay you. So if you're watching right now and you're kind of like, damn, but you want to take advantage of this information to build your wealth faster, here are 3 steps you can take to get there. First, you need to realize that it all boils down to the interest rates, and you need to play the game just like the banks do. The problem is, if you store your money in any of the traditional savings accounts that the big national banks offer, like Chase, Wells Fargo, or Bank of America, you're missing out on a lot of money. All these big national banks take advantage of you by paying you a terribly low interest rate. Like we said, Chase has that 0.01%, Bank of America also that 0.01%, and Wells Fargo, surprise, surprise, also 0.01%. With that rate, they might as well just slap you in the face because at least you'd notice something. But you also don't want to take your savings out and keep it under your mattress because inflation is gonna eat away at its value. So as someone who's worked in finance for years and kind of knows the ins and outs of the system, I personally keep my savings, like my emergency fund, down deposit for a house, and vacation funds in this thing called a high yield savings accounts, or HYSAs. The main reason, they can pay you 51.5 times more money compared to the big national banks. For instance, I receive hundreds of dollars in interest every single month for just keeping my money in a high yield savings account. I don't have to do anything. High yield saving accounts like Lower Road and UFB Direct pay you more than 5% interest, meaning if you keep $10,000 in Lower Road's high yield savings accounts, they will pay you $515 by the end of the year. And this is compared to Chase paying you $1. The reason high-yield saving accounts can pay you so much more is because they're online banks, meaning they don't have any physical retail locations. And since they don't have any of those overhead expenses, they can pass more money to you. I mean, other than that, a high-yield savings account is pretty much identical to a traditional savings account in nearly every way, except that they pay you a lot more money. But you do want to look out for 3 things when picking a high-yield savings account. One is that they're FDIC insured, meaning that you're insured up to $250,000 in case anything happens. This is pretty standard, even national banks like Chase are FDIC insured. 2, you want to make sure that the HYSAs have no monthly maintenance fees, and 3, that they actually pay a high interest rate. Like generally, you want to look for something that's over 4%. If you're interested in opening a high-yield savings account, I'll leave my favorite ones that I recommend to my friends and family in a link below. These are all FDIC insured, they have no monthly fees, and they all pay anywhere from 4.25% to 5.25%. Next, think about debt differently. Most personal finance advice categorizes debt in 2 ways: good debt and bad debt. Good debt is anything that's spent on things that can appreciate or increase in value over time, like taking out a mortgage on a house and student loans. Bad debt is anything you spend on stuff that decrease in value over time, like taking out a loan for a new car or using your credit card to buy Mr. Magic lamps. And I sometimes talk about debt like that too because it's easy for most people to understand the difference. But there's actually a much better way to look at debt, and it's based on potential returns. So take student loans, for example. Most people would argue that taking out a loan for college is good debt, because after you graduate, you can potentially earn more money. But I don't think that that's necessarily true. The general rule of thumb is to not borrow more in total student loans than you expect to earn the first year on your job after you graduate. And there's 2 reasons for this. First, the idea is that with yearly salary increases, you should be able to keep up with the interest in your debt and pay it off. And 2, you don't want your debt repayments to take up a disproportionate amount of your monthly income, because then you're gonna have trouble meeting your other financial goals, like building an emergency fund, saving for a pineapple pizza fund, or even having enough to invest. For instance, you probably don't want to borrow $100,000 to get a degree in the philosophy of herbology because the employment prospects after you graduate probably aren't the greatest. On the other hand, most people would argue that using a credit card is bad debt. But I think it's perfectly okay to use your credit card even to buy unnecessary things like going on a shopping spree. But it's as long as you can responsibly pay it back on time in full. Because using a credit card can also get you really great returns from purchase protection, insurance, and free travel with credit card reward points. Next, use the BBD strategy. In the 1990s, Professor Edward McCaffrey revealed how the wealthy use the banking system to build wealth and avoid taxes. He called it the BBD strategy, and it has just 3 steps. Step 1, buy an appreciating asset like real estate, stocks, or this $120,000 banana duct taped to the wall. Basically, these types of assets go up in value over time. Home prices go up on average 4 to 5% every year, the S&P 500 returns around 7% every year, and art goes up in value too, but it's a bit more variably. Step 2, you gotta realize that the rich don't necessarily want to sell their assets just to fund their lifestyle or make other investments. Because 1, they'd lose out on the potential returns for that asset, and 2, they'll have to pay capital gains taxes on the profit. And that's where step 2 comes in. Borrow. The rich can get money for the assets without having to sell them. For instance, if John has a $10 million stock portfolio that returns 10% per year, and he needs $1 million to fund his lifestyle every year for stuff like Michelin star dinners, a vacation in the Bahamas, and a new Tesla Cybertruck, what can he do? Option A is to sell $1 million of his investment portfolio. But the problem is he'd be forced to pay up to 37% in taxes, which could add up to $370,000. Plus, he'd miss out on the future expected 10% return of that $1 million if he had just kept it invested in the stock market. On the other hand, option B is to simply go to the bank and take out a $1 million loan against his portfolio. Banks might charge him a 6% interest or $60,000 a year for that loan, which doesn't sound great. But it doesn't really matter, because remember that $1 million is still invested in the stock market and is returning 10% or $100,000 per year. At the end of the day, John still profits $40,000, and he can keep borrowing more loans every year to pay the interest on the previous loans while keeping his investments intact. As long as the assets appreciates faster than the interest rate on the loan, John comes out ahead. Step 3. If now you're wondering, how long can John keep this up? Well, it's until he dies. Those who inherit John's estate might have to assume or pay off those loans, but they can follow the same BBD strategy themselves, or they can sell the stocks and potentially not pay any taxes on them thanks to the stepped up cost basis. But if you don't have $10 million sitting in an investment portfolio, first of all, don't worry, you're not alone. But for most people, you can still take advantage of a version of the BBD strategy if you own a home. You can simply refinance your property and pull out cash from it tax-free, since borrowed funds are not taxable. For example, if you have a property worth $220,000, you may be able to refinance 80% of it and pull out $176,000 to use as cash. But what if I told you that there's another ingenious strategy that the rich do to maximize their wealth? And the great news is it's something that you can start doing today. Click here to learn exactly how the 1% manage their money so you can do it today.